studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
Let's begin by understanding how a corporation can earn dividend income. Most people are familiar with individuals investing in shares and receiving dividends. But corporations can do exactly the same thing. A corporation can invest its surplus cash by purchasing shares of another corporation. And when that company declares a dividend, the investing corporation receives dividend income. Imagine two corporations. The first corporation is an operating business. It manufactures products, provides services, earns business profits, and pays corporate tax on those profits. Instead of distributing all of its after-tax profits directly to its individual shareholders, it may pay a dividend to another corporation that owns some of its shares. This second corporation is often a holding company or an investment corporation. Because it owns shares of the first corporation, it receives the dividend as investment income. Dividend income can also be earned from investments in publicly traded companies, private corporations, mutual funds, and certain other investment vehicles that distribute dividends. The important point is that the receiving corporation is not earning this income by actively operating a business. Instead, it earns the income simply because it owns shares in another corporation. That is why dividend income is considered one of the major categories of corporate investment income. At this stage, you might wonder why dividend income has its own separate tax rules instead of being treated like interest income. The reason is that the money being distributed as a dividend has often already been taxed once inside the corporation that originally earned the business profits. If the same profits were fully taxed again every time they moved from one corporation to another, multiple layers of tax could arise on the same income. To prevent this, Canada has developed a special system for taxing corporate dividend income. In the next few sections, we'll learn how this system works, why connected and non-connected corporations are treated differently, and how mechanisms such as Part 4 tax and refundable tax accounts help achieve tax integration while avoiding unnecessary double taxation. Now that we understand how one corporation can receive dividends from another, the next question is, why doesn't Canada simply tax those dividends the same way it taxes interest income? The answer lies in one of the most important principles in corporate taxation: avoiding double taxation. Let's walk through the process. Imagine that corporation A is an operating company. It manufactures products, provides services, earns business profits, and pays corporate income tax on those profits. After paying its corporate tax, the remaining after-tax profits belong to the corporation. Suppose corporation A now decides to distribute part of those profits as a dividend to corporation B, which owns shares in the company. At this point, ask yourself an important question. Should the same corporate profits be fully taxed again simply because they moved from one corporation to another? If the answer were yes, the same dollars could be taxed repeatedly every time they were passed through a chain of corporations. This would create multiple layers of tax on the same profits, making corporate structures unnecessarily expensive and inefficient. To avoid this problem, Canada's corporate tax system includes special rules for intercorporate dividends. The underlying idea is straightforward. The profits earned by corporation have already been subject to corporate income tax before the dividend was paid. When those after-tax profits are distributed to another corporation, the tax system generally tries to prevent those same profits from being fully taxed again at every corporate level. This doesn't mean that dividend income is always tax-free. Instead, it means that dividend income follows its own unique set of tax rules, designed specifically to balance two important objectives. The first objective is to prevent multiple layers of corporate taxation on the same profits. The second objective is to ensure that the tax system remains fair and that tax integration is preserved when the profits are eventually distributed to individual shareholders. As you'll see in the next sections, the Canadian tax system accomplishes this through concepts such as connected corporations, portfolio dividends, Part 4 tax, and refundable tax accounts. For now, remember the big idea. Corporate dividend tax rules exist because the profits being distributed have usually already been taxed once. The purpose of these rules is to prevent unnecessary double taxation, while ensuring that the appropriate amount of tax is ultimately paid when the profits reach individual shareholders. Before we begin learning the detailed tax rules for corporate dividends, it's helpful to step back and look at the entire process from a high level. Understanding this overall framework will make all of the upcoming concepts much easier to learn. Let's start at the beginning. Corporation operates an active business and earns business profits. Before anything is distributed, the corporation pays corporate income tax on those profits. After tax profits then remain inside the corporation. Next, corporation A pays a dividend to Corporation B, which owns shares in the company. Corporation B now receives dividend income. Eventually, Corporation B may also distribute those profits to its own shareholders as dividends. At that point, the individual shareholders report the dividends on their personal income tax returns and pay personal tax. This entire journey illustrates how corporate profits move through the Canadian tax system from being earned to being taxed at the corporate level, to being distributed between corporations, and finally reaching individual shareholders. Notice that this journey is quite different from interest income. Interest income, such as interest earned from a bank account or a GIC, is generally included in taxable income in full and follows the ordinary corporate investment income tax rules. Dividend income, however, follows a completely different set of rules because the profits being distributed have usually already been taxed once before the dividend was ever paid. This is why Canada has a separate system for taxing corporate dividends. Instead of applying one simple rule, the tax system uses several connected mechanisms to ensure that the profits are not taxed repeatedly as they move between corporations, while still making sure the appropriate amount of tax is eventually paid when those profits reach individual shareholders. As we continue through the next chapters, we'll build on this framework step by step. First, we'll learn the difference between connected corporations and portfolio investments. Then we'll study Part 4 tax, followed by the refundable dividend tax on hand, or RDTO. And finally, we'll see how dividend refunds complete the process of tax integration. For now, don't worry about memorizing those technical terms. The important takeaway is simply this: corporate dividend income is taxed under a separate system because the profits being distributed have often already been taxed at the corporate level. Everything you learn next is designed to prevent multiple layers of taxation, while ensuring that Canada's tax integration system works fairly and effectively.